Anyway, let's see how it goes. Hello and welcome to UTI Swatantra. The big question that many investors ask is, how do you behave or how do you engage with markets when there is a volatile period or a period of volatility? Do you go in? Do you stay out? Do you manage and carefully find your way around? Well, these are very, very important questions to ask when you're investing in financial markets for the long term. And who better to answer this question than someone who's worked in the financial markets as a fund manager for a long time? My guest today is Ajay Tyagi, Executive Vice President and Fund Manager at UTI Asset Management Company. Thank you so much for joining us, Ajay. I know, Ajay, you're not feeling too well today, so thank you for taking time off and making it despite all the difficulties. So let's talk about volatility, right? So you've obviously seen a lot of it, and you've been in the markets for almost 20 years now, and that's a sufficient period of time through which you've seen ups, downs, thick, thin, and all of that. So what does volatility mean to you as someone who invests large sums of money in the markets?
Sure. So first of all, thanks for having me here. I think if you look at the dictionary meaning of volatility, it basically means a sudden or unpredictable change in anything. When we talk in terms of financial volatility, we basically mean that a sudden and sharp drop in asset prices. Although volatility can be in both directions, but more often than not, when we invoke this word volatility, we basically mean a sudden and precipitous fall in asset prices rather than a sudden rise in asset prices. So I think times like these, where markets till about 3 or 4 months were chugging along fine, and then because of global events and because of things like the trade wars, you start to see the contagion spreading into various parts of the world, and asset prices, particularly equity prices, falling. That's the perfect time when you say that markets have become volatile.
Okay. So, and when you say that, how do you see it as a fund manager? And then we'll come to what an investor should do.
You see, volatility, not just now, but I would say 70 years back, many of our investors would definitely know Warren Buffett. But Warren Buffett used to have a teacher of his own or a mentor of his own who was called Benjamin Graham. In the 1950s, he wrote a book, and he basically told us back then itself that volatility is a friend of the investor rather than the enemy of an investor. And he in fact personified this whole thing by coining a term known as Mr. Market. So he basically said that if you were to consider the market to be a person and you call him Mr. Market, then this character is basically a manic depressive character, because he is fickle minded, he changes his mind every day. He doesn't realize that the underlying asset values ought not to be changing their prices so viciously and therefore not being as volatile. But on a daily basis, this character would come out and at times feel outrightly optimistic, and on certain other days turn out to be extremely fearful, and therefore quote either too high prices or too low prices for the same asset, which obviously wouldn't have changed in its internal intrinsic characteristics as much. Now suddenly cut to 2018 and you realize that absolutely nothing has changed in the last 70 years. Markets again continue to remain volatile. You attribute that to how investors behave and how investors always want instant gratification. They basically want to continue riding on a particular trend, and the minute the trend gets broken, they basically become fearful and start selling out. But for any thoughtful investor, any disciplined investor who has a long time frame, typically a fall in asset prices, which again we term as volatile times, is actually the best time to increase allocation towards that asset. And I think so that story continues pretty much even today.
Right. So how do you, and we're going to talk about whether it's good or bad, but how do you know that it's volatile enough for me to actually step up my engagement or investment in the market?
Sure. So now we're getting into something a little more technical, which is about the valuation per se.
You could use the example of what we've seen in the markets in the last 6 months, let's say.
Sure. So I think the first rule itself is that if you were kind of falling over one another, trying to buy a particular asset or a particular stock at, let's say, ₹100, and when that asset price falls down to 80 and yet you are not exhibiting the same behavior, it basically means that there is something wrong in the way you're thinking about it, because in 6 months obviously that particular asset wouldn't have changed its economic characteristics as much. You were ready to pay 100 rupees then, and you basically at that point in time felt that you just can't have enough of that, and when the prices are around 20%, you're not exhibiting the same behavior. So that's the point where investors really need to kind of take a step back and say that, look, am I doing something really foolish? And it's over here that I need to remind all investors that, look, there is something known as the typical demand curve. As consumers, all of us follow the typical demand curve of economics, which basically means that when prices rise, you reduce consumption. When prices fall, you increase consumption. So if there's a sale, at Shoppers Stop today, for the same, kind of apparel that which you were getting for, let's say, 3,000 rupees, if they give it to you at 2,500 rupees, you would want to lap it up, not the other way. But when it comes to, buying stocks, we need to first of all understand that stocks represent a underlying interest in a business. So the business is intact, of course. It was available at 100 rupees 6 months back and you wanted to buy it. Now prices have dropped down to 80 rupees. Ideally, you should be buying even more, following the same principles of the demand curve, but you don't do that. You actually swing just the other way, and at 80 rupees, you want to sell it. So I think that's the first step which investors should realize, that they are doing something wrong and they are doing something perverse as against how they behave when they are a consumer and how they behave in terms of the price of the underlying merchandise which they want to buy.
But you have to convince yourself that the underlying value or the value is something that is good at this point of time, right? So the 80 rupees that you're paying today, you have to convince yourself, or someone has to convince you that it's worth paying 80 rupees for that asset today, and something has not gone wrong with that asset. To use your Shoppers Stop example, if you're getting something worth 3,000 rupees for 2,500, that means it's a good deal because that asset is the same. In this case too.
So this is where then we move a step ahead and then we get into and we just can't avoid this entire exercise of valuation and finding out the intrinsic value, and therefore we just try and invoke certain simple rules of valuation. So, one of the surest rules of valuation is trying to buy companies which generate cash flows and return back those cash flows to investors in the form of dividends, right? Most other ways of valuation, to my mind, are a bit speculative because you try to conjecture the value of an asset by saying that this can grow by so much over the next 5 years, this industry is a sunrise industry and so on. But if you were to use a common denominator of figuring out how much are the cash flows being generated and therefore how much are the dividends being paid, you get a fairly good idea. So dividends, by the way, for all strong companies and high quality companies don't move as much as their share prices. So share prices of even the most blue chip of the company can move up or down by 30-40% in a year, but their dividends actually will not. In fact, dividends for solid companies only keep on increasing. If you were to just look at something known as a dividend yield, for those of us who invest into real estate, there is something known as a rental yield, which is the kind of rent that you get by buying a property and putting it.
Which is terrible in the city like Bombay.
Exactly. So if you were to even use simple things like a dividend yield, you will realize that, look, I was getting a 3 rupee dividend when I was paying a 100 rupee for this stock. So it was a 3% dividend yield. At 80 rupees, I'm now getting, let's say, close to almost 4% dividend. Or at 4% dividend yield. So which basically means that, look, this is really attractive for me.
Yeah, particularly for a company which is known to give dividends at frequent intervals or every year and keep investors happy.
So these are the kind of things which people can do in terms of figuring out. And if, by the way, you don't want to do that exercise for stocks individually, you have enough data to figure out what's the dividend yield for the market per se. So you know what's the dividend being paid by the BSE 30 companies or the Nifty 50 companies. You do the same exercise when, let's say, BSE 30 was at 40,000 index value. And this was the dividend given by those companies. The dividend yield worked out to 1.5%. And at, let's say, a price of BSE 30 being at 30,000 index value, the index yield has risen above 2%.
Right. So in your experience now, I mean, keeping all this in mind, including the valuation, the ability to value, do you feel that most investing has managed to get around the volatility, in the sense that if you look at a 20-year horizon, if you have been investing at times of volatility, you've largely been protected or you've been safe over time?
Absolutely. I mean, this is a very, very unequivocal yes. And in fact, before I talk about my own experience, let's just also look at the long-term track record of one of the finest investors like Warren Buffett himself. I mean, the fact that he has such a jaw-dropping outperformance against the benchmarks is predicated on the fact that he has used volatile times to his advantage by investing more and more. So I remember in 2008 November, this is pretty much the middle of the Lehman crisis because Lehman bankruptcy happened in September. The world came out of that uncertain period by March of 2009. So it was sometime in November when Warren Buffett was buying like crazy, and he actually made a statement which said that if you wait for the robins, spring is gone. So basically, you just can't wait for enough data points to get that comfort of buying just when equities are going to have a bright future. You always have to feel a bit uncomfortable when you are increasing exposure, and which is the story all the time.
Right.
Coming back to the Indian context, I can just only say that equities ultimately are an asset class which follow the underlying earnings growth. In a high growth economy like India, which we have been for 25 years on the trot, growing at somewhere around on an average 7% or 7.5%, because of the strong GDP growth, our underlying companies have had very strong sales growth, profit growth and cash flow growth.
Yeah.
And all of this ultimately...
Or is it the other way around? Companies have grown well and fast and strongly, so therefore GDP growth...
It's getting reflected in the economy. So you're absolutely right. That's the cause and effect.
Yeah.
But just to make the investors understand, if they do believe that this economy is continuing to do well, if they do believe that we would be amongst the large size economies, one of the fastest growing economies, then a corollary to this is, or rather like you said, the cause of this is going to be the fact that our businesses are going to continue doing well, and our businesses will continue throwing up 15, 17, 20% kind of earnings growth. And should that happen, in the fullness of time, you would see the stock prices also reflecting that. Now, considering our own 20-year experience, I can only talk about the 1998 Southeast Asian crisis, 2000 dot-com bubble, 2001 9/11, 2007 and 8 Lehman crisis, 2011 European crisis. I mean, we've lived through all of that, and yet for any long-term investor, his track record of his wealth being accumulated by staying invested into the equity market has been phenomenal.
Right. Okay, great. So we've got a bunch of questions that have come in, and what I'll do is I'll merge some of those questions and also move into the next phase of our discussion, which is to say, how do you now do all of this, the tough part that you said, trying to figure out what the jargon is, trying to figure out what is volatility, the yield and everything, and basically make it your job as the fund manager to manage it, while I only give you a certain amount every month as a systematic investment plan. So here are some of the questions. Amit Sharma asks, are market downswings good time to invest in mutual funds? A second question is Kundan Lal Jain, who says, hello sir, are debt markets safe from market volatility? Akhilesh Sarate asks, what causes market volatility? And finally, there's a question on safe equity investment, which I'll come to. So let's address some of the conceptual questions. Are market downswings good time to invest in mutual funds, since we were going to segue into mutual funds in any case? And are debt markets safe from market volatility?
So I think let's take the second question first. Well, volatility hits all asset classes, but they hit asset classes in different measures and in terms of different magnitude. So even debt is a volatile asset class. As you would have seen in the last 6 months, as interest rates kept moving up, the prices of underlying debt securities kept moving down. So prices of a debt security and interest rates are inversely related to each other. So whenever interest rates in any economy move up, debt prices move down. So therefore, if you are an investor in a debt mutual fund, you would also go through periods, albeit short periods, where your returns from that debt mutual fund could perhaps even be negative.
Yes.
So to that extent, for somebody who is investing into a debt mutual fund, thinking that life here is absolutely linear and you would only see returns getting positively accumulated and never see a drawdown, I think we need to clear that misconception. Even debt funds can give you negative returns in certain time periods, albeit very, very short time periods.
Right. So bottom line is, they're not safe from market volatility.
Absolutely not. Don't ever imagine that you're investing into a fixed deposit product, which will only give you an assured 6.5–7%.
Right.
Over long periods of time, debt funds ought to be giving you higher than fixed deposits, which pretty much is the case if you look at long-term returns.
Right.
Equity, on the other hand, is definitely a much more volatile asset class compared to debt, and therefore equity mutual funds are more volatile compared to debt mutual funds. Now, your first question was that
are market downswings a good time to invest in mutual funds?
Again, an absolutely thumping yes. You see, I think over time, as this industry in India has evolved, we've also realized, and all of us over here have realized, that SIP remains the best route for investors to invest into the stock market. Because even professional investors can't time the market and say that, look, this is the best time and this is the peak and you ought to be either going in or coming out. Now, while that discipline should be unbroken and investors every month should be literally investing and keeping aside something for their future nest egg by investing into equity mutual funds, but volatile times like these when the same asset is being thrown at you, when Mr. Market, that manic depressive character, is throwing the same asset at you at 20% or 30% discount, you ought to be actually lapping it up. So let your SIP continue. If you do have certain excess savings, do make a lump sum investment during volatile times. It only betters your long-term track record. That's how the world's best investor, Warren Buffett, has improved his long run averages, by using such occasions to increase allocation.
Right. And a somewhat related question is from Chandaluri Nageshwara Rao. He asks, which is the safest equity investment in volatile markets?
Well, again, safety is a relative word, but if you were to really talk about, and here, like I said, everything is relative.
Yeah, safety and equity may not necessarily go together.
Exactly, go hand in hand. So we can only be relatively safe compared to some of the others, within the equity space. So I think go for companies which have a very long track record, go for companies which have been listed for 20, 30 years, have a very long listed track record. So you know those companies well. They've had a unabated record of paying dividends year after year, and not just that, in fact increasing the amount of dividends year after year. So these are companies which have tried, tested, established business model. Also look at companies, by the way, which have very low debt on their balance sheets, in fact have absolutely zero debt or even cash on their balance sheets, because these companies, and I can say that with a reasonable amount of certainty, don't get rocked when times become volatile, right, and liquidity becomes tight in the entire system, because they generate enough cash flow to survive.
Right. So the other question is, which I had, is should we invest in equity funds when markets are volatile? So you're answering that in a different way, because you're talking about the stocks that equity funds will invest in when markets are volatile.
Yeah.
Assuming the fund manager is thinking through all this, and that's, I guess, a safe assumption.
That's a safe assumption. Yeah.
Yeah. Okay. So let's talk about the next question. So is it wise to only invest in debt funds to totally avoid volatility?
Absolutely not. And again, here I must invoke certain golden rules written by experienced advisors on the Wall Street, and I think advisors here in India would also agree with this, which is that the simplest rule for investing is the fact that 100 minus your age should be the amount of investment that you should be making into equities as an asset class. So if let's say you are a 25-year-old young boy who's just started working, 75% of your investment ought to be in equities. For a minute, forget volatility or no volatility. Every month you need to save, and you have to decide how much you want to save. You have to save and park 75% of your assets into equities. So to that,
so if you're 30, it would be 70%.
Exactly.
And the other 30% goes into debt.
It goes into debt. Okay. And if you're 70 years of age, and basically you have entered into a phase of life which we call as dis-saving, because you don't have a source of regular income, and therefore you are trying to sell out of your nest egg which you have created over the previous 40 years, you basically ought to be parking more and more money into debt, because like your previous question, debt is definitely much less volatile than equity.
Right, but even if you're 70, but even then 30% should be going into equity.
Because life expectancy is increasing,
right,
and you might live another 20 years, who knows.
But that money is going to come from selling off something, or?
So how typically we manage this is, so let's say you are a 50-year-old, you have 50% into equity, 50% into debt. You have to keep reducing down your exposure into equity. So and suppose you're working till the age of 60, incrementally don't invest as much into equity, invest more and more into debt. When you become the age of 60 and your process of dis-saving starts, because you're basically taking money out of your nest egg, start taking money out of equity rather than selling debt. So I think there are ways to manage it, but the fact remains that these are broad brush rules. They may not apply in the same fashion to everybody, but I think that's where we have to be very, very clear about our thought process. And therefore, equity investment is not just about investing only during volatile times. Just like I said that volatile times are actually good times to increase allocation into equity, but you can't take the exact reverse of this and say that only during volatile times would I make investments into equity.
Right. So we are still taking questions. If you have any, please send them to Ajay Tyagi, Executive Vice President and Fund Manager at UTI AMC. So Ajay, here's the other question. So are we, as we invest in the markets, in volatile markets, we also would like to know whether we are in volatile markets.
Sure.
Right? Because sometimes markets may go up or down and correct. As you said, it's usually when it goes down that you think it's volatile. And it acquires some degree of stability very quickly. So what are we in today, right now, as we sit here?
So I'll very clearly define this as volatile times, and I think there are reasons for this. The biggest reason, of course, has been the fact that globally we have entered into some bit of an uncertain period, And please, look at this data, which tells us that US markets, which are typically the driver of global markets, have been in a bull run for 9 years on the trot.
Yeah.
The second highest period ever, and we might actually, if we go on into a bull market for another year, we might call it the longest period ever in the history of US equity markets. So that itself tells us that you are pretty much at the fag end of the bull market in the US. And although we always keep talking about, and we love to talk about this whole concept of decoupling, saying that emerging markets, particularly India, are not coupled with the world, we are decoupled with the world. But finance history again teaches us one thing, that whenever there is a risk of event in the world, whenever globally things become uncertain, there is a sell-off in all asset classes for the first few months. It's only after a few months that people then realize that okay, India needs to be viewed from its own perspective of its own growth over the next 3-5 years, and therefore start valuing India differently from how you would value the developed world. So I think the first reason is volatility is happening because people are jittery about the longevity of this bull market in the US and the trade wars that US and China have embarked on. I hope better sense prevails and these trade wars do stop at a particular juncture without a lot of damage being kind of passed on and permeating into the other parts of the globe. The second reason for volatility is basically a bit of anxiety about the political formation in this country in May 2019. Recent data has not been too gratifying in terms of continuity of the present political formation.
Right, and markets like certainty.
And markets like certainty.
Yeah. It doesn't matter who comes, but as long as there is continuity.
Absolutely. Yeah. So I think investors are jittery about the outcomes in December when the state elections results are announced. Markets are jittery about the final outcomes in May. And I think that is also keeping a lot of investors on the sidelines. Be that as it may, regardless of all of these reasons that I mentioned, please do remember that the classic definition of bull markets, which is that bull markets always get built on extreme pessimism. So when there is blood on the street and you just can't see the end of the tunnel, don't forget that in the long term, investors who have lived through this period and have continued with the discipline of investing have actually been rewarded.
But we are not in that phase of extreme pessimism either.
Things have not become as bad.
Right.
I'm just sounding out that if, let's say, things were to become bad in the next 3 or 4 months, don't forget this mantra. We are somewhere in the middle today, where
so in the middle also you should continue to invest.
Absolutely.
Right? Yeah, because if you're thinking that okay, let me wait for things to get worse as opposed to let's say getting much better. Sure. Because I'm waiting for either extreme to start.
So you're absolutely right. You can just never guess the next 6-month movement in the markets. And I think again history has taught us one more aspect about investment, which is that if you sit on the sidelines and you miss, let's say, the 2 or 3 really strong days when the market suddenly moves up, you have really retarded your longer term averages significantly. So never do that, never sit on the sidelines, continue with the discipline of SIP. Mm-hmm. The only mantra that we need to remember is that during volatile times, add more. Don't actually pull yourself out from the markets.
Right. So which brings me to my last question. So what's the better way to invest in mutual funds during volatile markets? Is it the systematic investment plan or lump sum or both? And if you were to build a small model portfolio of investment, what would it be like?
So I would say again, none of us can predict the markets. At least as a professional fund manager, I have realized that it's absolutely foolhardy to trying to do a prognosis on what the market direction would be in the next 6 months or 1 year. So the best way is in a disciplined manner, keep doing SIPs, which should continue regardless of volatile times or cheery times. However, during volatile times, add more. So when investors ask us, do I make a lump sum investment? Typically, this question comes to us when markets are cheery, when the consensus is cheery, when markets are chugging along well and the momentum is all in the positive direction. I would say that the best time to make lump sum investments are not those. So the best time to make lump sum investment was not 2017. The best time to make lump sum investments, I would say, has started from June, July of 2018. And even today is a great time to make a lump sum investment in addition to SIP, which is like I would say your Bhagavad Gita. So you just don't forget that. You always keep keep that as a habit without missing it.
Right, Ajay, we've run out of time. So just to a very quick sum up, I think these are volatile markets are good times to invest. Don't be afraid of volatile markets for reasons recorded in history of the financial markets and by greats like Warren Buffett and Benjamin Graham. It's important that you look at the underlying factors, which includes the companies and of course the economy. And if you trust in the economy, then that's something that you should bet on. And if you all trust the economy and where it's going, then we have no reason to be afraid of volatility. And also use volatility as a friend to invest, and particularly invest larger sums, as is a good moment right now. Where we are at this point in 2018 end. So thank you so much, Ajay, for joining us. Glad that you could make it, and hope to see you soon.
Sure.
Well, that's all we have time for on this edition of UTI Swatantra. We're going to be back on the 27th of November, Tuesday at 5:30, and we're going to be talking about arming your finances with mutual funds. Thanks for watching.